Okay, so welcome back this evening again. And one thing that we need to ask ourselves is whether the scalping strategy is the right strategy to adopt for a newbie to the trading market. And my take on that is that even though an instrument may range for for an hour, let's say, if we're snatching 3 pips here and then 7 pips there and 2 pips there, we may end up getting caught out if certain fundamentals then change. If certain news comes in that affects the market and that affects that particular commodity or that particular instrument, we could then end up getting caught out because if we're scalping, scalpers don't tend to use stop losses because that defeats the purpose of the scalping strategy. The scalping strategy lends itself towards a trader simply trying to get 3 pips, they close the trade, and then they enter the market again. 7 pips, 2 pips, close that trade again. So, one danger is, of course, that you get caught out in the event of a sudden move in the market that goes against the trades that we're making. Another danger, well, not a danger, another reality is that remember, for each trade, you're paying a one-off commission. So let's say you're making a trade for $1 per pip move. $1 per pip move. As soon as you place that trade, as soon as you click on buy, you pay $1. And if you're only getting $3 out of that trade, and then you go into the market again for another scalp where you have to pay $1 again, and you get $7 this, $7, 7 pips this time. So that means you've paid $2 in commission in the spread for 10 pips when you could have paid $1 in a single trade. So scalping for experienced traders is a strategy that I know is adopted sometimes, but it's not the best strategy, especially if you don't want to be caught out on the counter trend. So let's take a look today at the technical Forex trader. We'll try and take a look at the fundamental Forex trader as well, and we'll take a look at indicator assisted trading, the multifaceted trader as well. That is a trader that adopts both the fundamental strategy where they understand the news that's going on, and then they use that to determine when a trend might change according to their technical analysis. So the technical Forex trader. So there are two methods a trader can adopt to analyze the FX markets, and that's technical analysis, as we've said, and fundamental analysis. Third method, which we don't normally talk about really, is the multifaceted analysis method. That is the trader who uses the fundamentals to determine when the technical trend is going to turn. Now, remember, I've said that I'll share this screen time and time again. So we've got the market moving from a support, between a support and a resistance, and that is where we buy as traders. We observe the market moving between support and resistance, and we buy at a support and we sell at a resistance. That is all we're doing in between our trades. We're buying at a support, we're taking profit just before the price hits a resistance, then we're selling at a resistance, we're taking profit just before the mouse hits a support. So that's all we're doing when we're trading. Now let's go down to here. So what do technical Forex traders seek to do? They seek to determine the worth of a country's currency based on historical price action. That's all they're looking at. What has happened in the past, and that helps them to gain a sense of what is going to happen in the future. Pure technical traders base their trading decisions on historical candlestick patterns, chart patterns, and they totally discount or have bare regard for economic or political news that could affect the currency or share price. So some technical traders will say, and I've had this in the past when I used to trade, I do not need to know what's happening with regards to the news. I don't need to know what's happening. I don't need to know whether there's going to be an election in the States. I don't need to know whether there's an uprising in the Arab Spring, for example, that could affect oil prices. They will simply say it does not matter. So technical traders, they're also described as trend traders based on their observations of a historical trend. Now, how do we view historical price action? So last week we took a look at candlesticks, and you select a candlestick for a set period, either a daily candlestick, weekly, monthly, 4-hourly, hourly, quarterly, 5 minutes or 1 minute, and you hover your mouse on this and you view the opening price, the high price, the low price, and the closing price for the period. That's how you view historical price action, what has happened in the past. Or again, remember the first day we went through the toolbar and we went to the history center, and you can see the currency or commodity history that we need so that we can obtain historical price action information. But very rarely do you need to go through the history center. All you need to do is click on the candlestick and then just view it there. So the candlesticks, they display the open, high, low, and closing prices of a currency, commodity, or stock. And remember, we said that each candlestick represents a period of trading activity, 1 minute, 5 minutes, or a day, or 4-hourly, as we've just said. The hollow or filled pattern of the candlestick is called the body, and the long thin lines above and below the body are called shadows or wicks. The candlesticks, remember we said that we can change them under the tools menu. Right, so the shape of a candlestick, of course, can help a trader, a technical trader, to know when to enter or exit a trade. And we'll take a look at some of those patterns on this PowerPoint presentation this evening, because we took a look at some last week. So what is a doji? And I know that I was asked this question repeatedly last week. A doji is when the opening price of the currency or stock and the closing price are the same. So the candle forms the shape of a cross with no body or sometimes a slight body in the middle. What does that cross indicate? It simply indicates that the price opened at a certain point, at a certain value. The price went up, or it went down first, could have gone down first and then up, and then it came to close at the opening price. That is a perfect doji. So the price goes up and then down, and then it goes or down and up, and then it closes at the exact opening price. Then that's a perfect doji with no body in the middle. But if the price closes with a body in the middle, either bearish or bullish, it means that the price closed marginally above or below the opening price. And we'll take a look at a candlestick like that in a moment. So a doji candle simply suggests that the buying pressure is the same as the selling pressure. So that means that the price tried to go lower, but it was met with buyers. The price tried to go higher, it was met with sellers. And so it came to settle, it came to close that period at the same price as the opening price, because the buying pressure was equal to the selling pressure. So we've got 3 types of dojis. So here's one where the upper and the lower shadows are equal in length. And that means, as we said earlier, that the buyers in the morning were equal to the sellers. So the buyers, so the price came down to this support, went up to that resistance at the top there, the peak of that wick, and then it came to close at the opening price, which is the cross in the middle here. So that is a standard doji. Then there is a gravestone doji. This is where the price simply went up because buyers bought the instrument all the way up here, and then the price came to close at the same price at the opening price. So it didn't go down that day. And that is a gravestone doji. And what that is simply saying is that although some buyers bought the instrument up to this point at the top of the wick that day or over that period, it was met with sellers, and the sellers were so strong that they pushed the price back down to the opening price. So that is a gravestone doji. So please don't worry about the names that I'm referring to these as. Just understand the action that took place. So where you see a long wick that's gone up and then the price has come back down to close at the opening price, especially if that is at the top of a move up, of a long run up, that would mean that that instrument has hit a resistance. The price has hit a resistance and it's now come down to close at the opening price, which would suggest that the next day, this is likely to fall because the resistance was so strong there that they've managed to force it down to the closing price, to the opening price, to close at the opening price. Then we've got the dragonfly doji. Now what's happened here is that the prices open at a certain price in the morning or over the period, whether it's a 4-hourly candle or whatever period that is, the price is open there and then it's gone down. Sellers have tried to sell it down to a support, but it's been met at a support with buyers. So buyers have bought it back up to the opening price. So that's called a dragonfly doji because it looks like a dragonfly. But whatever the case, the most important thing, as I said, is understanding the price action that has taken place there. So if that's at the bottom of a long fall, that means that it's opened here, opened this low, then it's tried to go lower. The price has tried to go lower. Sellers have tried to sell it lower, but it's reached this point at the bottom of the wick, and that price has been met with buyers. Buyers have come into the market and they've bought it back up to its opening price. So again, please don't worry about what that is called or, I mean, the names here. It's simply understanding the price action so that when you see these different shaped candles on your MetaTrader, on your chart, you understand exactly what's happened. And I'd still insist that it's easy once we understand one chart, once we understand the candlesticks, and I'll refer us to some sites where we can go and learn more about, further information about where you can actually go through a free school on trading where you'll understand a lot more than what we've been able to convey during these workshops. But there's some schools that you can actually attend online for free, babypips.com, which we'll talk about later, where you just go through and you'll get a thorough understanding for this whole for this and more. So let's take a look at the hammer and the hanging man. So when the price of a pair moves considerably lower after opening, and then bounces to close below or above the opening price. So not at the opening price, below or above. So let's look at this. When this is formed at the top of an uptrend, it is called a hanging man. And when formed at the bottom of a downtrend, then it is called a hammer. So let's take a look at these pictures. Okay, they are here. So what has happened here? So the price here is opened down here. Sorry, the price on this, which is filled with a white shadow here, that is a bearish candle because it's filled with a white shadow. The price is open at the top of this white shadow here. Open at the top of that white shadow. It has gone down, so sellers have sold it all the way down to the bottom of this wick. Then it has come to close here, right at the, well, it's at the bottom line of this white shadow. So that is referred to as a hammer if it's found at the bottom of a downtrend. If it's found at the bottom of if it's found at the top of an uptrend, then it's called a hanging man. And that's suggesting, if that's found at the bottom, at the top of an uptrend, that's suggesting that, okay, the price is open here, it's tried to go lower, and it's still come back up, but buyers have bought it up, but they haven't been able to push it up to its opening price. And when you have a hammer at the top like that, the best thing to do is to pause to see what the next day's candle will say, because the next candle may be a doji, which is suggesting that the market is undecided and that the market may be about to reverse. If it's at the bottom of a downtrend, it may be that the market is about to reverse, to go back up. And if it's at the top of an uptrend, then it may suggest that the market is about to go down. In this instance, this second hammer here, or hanging man, hammer or hanging man, depending on where it's found on the chart, the price is opened on this bottom green bar here from left to right. It's gone all the way, sorry, it's open at the top, open at the bottom here rather, of this green bar. It's gone all the way down to the bottom here to a support, and then buyers have bought it up, and they've bought it up to go and close above the opening price. So in this case, because this shadow is filled with white, the price closed below the opening price. But where it's black here, it's filled with black in between this body here, that means it closed above the opening price. And if this is the bottom of a downtrend, then that's definitely a bullish signal to buy. So these are different candlestick patterns that technical traders will use as signals to buy or sell an instrument. Now let's take a look at this this chart, or a few charts actually. Now, if we look at this chart on November the 28th, November 2008 rather, to December 2011, I just wanted to show us a few supports and resistances and a few candles here. So if we look here now, this is the weekly chart for the GBP USD or cable. If we look here, this was around November 2008, and then this was around January 2009. I can see from the bottom here, and we've got two supports that formed there. Then weekly candlesticks, these are, again in November 2009, and then this would have been around February 2000 and, sorry, November 2008, and this would have been around February or so in 2009, we had two resistances on the weekly candles. So the candles, the price went down on GBP USD all the way down to here in November 2008, then went up to there around November to December 2008, went up to there, and then we came down to this same support or around this same level of support in January 2009, and then say February, we were up here again at this same resistance. So again, all the price does is that it trends between support, resistance, goes down to that support to test that support again, goes up to that resistance, came down here, couldn't breach this support, and then it went straight up to here. Don't remember what news we had there. Went up to here where it met a mild resistance, and then it went up as high as this price. And this was around May 2009. Now we had all this action. This would have been through to June. Then July, we can see this pin bar here. This inverted hammer. Can we see this long pin here where the price opened down here? Then it went up to this resistance. We can see this long line here, went up to this resistance. Then it came to close below the opening price because there's a little white shadow there. And that was an indication that the price was about to drop. And then we then went down to test this same support from, and this was around September 2009 by now. We went down to test this same support that we'd tested in March 2009. Then over the next few weeks, again, remember these are weekly candles, we went to test this resistance again. Then we came down by December 2009 to test this support again. We tested this support, then we went up here and we tested a resistance, a minor resistance, and then we came down here. Went up again to test a minor resistance, then we came down to test this support, and by April 2010, which is down here, we can see this is around April 2010, we were back where we were in March 2009. Then we went up again because we couldn't break that support down to come and test this support. So we went back up again, tested this resistance, came down by August 2010. We were testing a support here. Went up again to test this resistance. This was around October 2010. Tested this resistance, which we tested in June or so. Then we went up to test the next resistance around November 2010, went to test this resistance, which we'd last tested in December 2009. So again, the price just moves between support and resistance, and a technical trader will take a note of all these supports and resistances and simply trade between the trends, between the trend lines. You can see again that it's doing the same thing here. This is now, we're now in November 2010 or so. Then we go up. This is around January 2011, testing this resistance again. Then we're actually trending between this resistance and this support where we were about 1.5 years prior, because we're now in January, or we're actually in March 2011 here. But if we go back here, we were last at that price in November 2019. So all the market is doing is it's going between trend lines, between trends. So all we need to do is buy at a support, take profit just before it hits the next resistance, sell at that support, take profit just before it hits, sell at a resistance, take profit just before it hits the next support, and keep doing that until it either breaks the support or it breaks the resistance. And the only thing that will preserve our equity when it changes direction and that trade is going against us is our stop loss. So again, if we take a look at by 2011, we were back down here. This is May 2011. We were back down in the same place as we were in November 2009. You can see all these ticks where I've placed them against these support lines. So it's not doing anything unusual as long as we can recognize the supports and resistance. As long as we can recognize all these patterns, we should be absolutely fine. And as I said last week, when you hear Bloomberg, so you should make, if you really want to trade, make Bloomberg your friend. You know, if you're working or doing other things, just turn Bloomberg on in the background and you hear them band these figures about. We've got buyers waiting at 1.52. Cable's got buyers waiting. They only know that because they can tell from historical price action that that is where buyers stepped in. So they're not magicians. They don't have a magic ball or anything like that. They're not prophets. All they can see is that this is what happened previously, and so this is what is likely to happen. Not what will happen. And that's why I said earlier that systems can predict what is likely to happen, but not what will definitely happen. So again, the best traders are not the traders that claim to suffer no losses. Rather, they're the traders that cut their losses short and let their profits run, which again, scalpers don't do, because scalpers don't let their profits run. They just try and snatch and grab as many, as many pips as they can using a fast trading strategy where they go in, quickly bank their profits, and then they open again, quickly bank and open again. But real traders, traders who are experienced, will cut their losses short, which means that there will be losses. They will have losses and they'll let their profits run. But we can't do that until we've actually understood ourselves and developed our own trading strategy, which we will talk about tonight. Hopefully we will get to that point tonight. But again, you can see here that by October 2011, we were here. So this is around October 2011. We were here at the same price we were, or just above the same price we were in October 2010, in August 2010, and around the same price that we were, well, that was a support in November 2009. So all we need to do is to try and identify the support and the resistance, support resistance. And here's what happened again in January 2012 and between January 2012 to January 2015 with the GBP USD. Again, you can see the multiple attempts to break a support and to breach a resistance. And this again is the weekly candlestick. But you can see here one 2, 3. Went up there. So this is from January 2012, went up all the way to there. Then it came down, then it went to that resistance. On the way down, it came back to this support by April 2012. And then by August 2012, which is down here, we were again at that same resistance. Came down, found support here in October 2012. And then this was around December 2012. We were at that same resistance again, that same resistance. And then we finally breached that support from January 2012. We breached that support around January 2013 and came all the way down here. Then we came again to test the same resistance by May 2013. So the market doesn't do anything different. It simply trends between A and B. Then it moves from B to C and then back down from C to B until fundamentals occur that change the course, that change the trend. Hence the saying, the trend is your friend. If you keep trading and following the trend, you can't go wrong with a stop loss. So this is just trying to indicate to us, support, resistance. And when a long-term resistance has been breached, it then becomes a support. So once a long-term resistance has been breached, it then becomes a support on the way down. So if we look at here, for example, so we tried to go up here, then we came here, this became a support, then we went up here. On the way down here, it didn't actually serve as a support because something must have happened, because we see 1, 2, 3, 4, 5 candles that came down quite rapidly, where the price fell quite rapidly. But on the way back up again, we found it was a resistance for a few days, that point, and then it went up here, then it came down here, and it couldn't just break this support straight away. So it went back again to test the resistance, then it fell straight through again for a support. Then up there, resistance again, down there, resistance again, came back down here to test this support again. And this is actually referred to, 1, 2, 3 here, is referred to as a triple bottom on a chart. Here, we've got a triple top, 1, 2, 3, where we met resistance 3 times. Now, I think I've heard some questions which tend to are leaning towards the how many times does a candlestick have to touch, or price have to touch a resistance before it breaks it. And traditionally, some traders will say, well, once it's touched the resistance or a support 3 times, it must break. But sometimes it won't break. Sometimes once it's touched that resistance 3 times, it's actually going down, as we can see here. It tried to break this resistance in February 2012, tried to break it again in August 2012, tried to break it again in December 2012, and it couldn't break it. And when it tried to break it in February 2012, it then came down to test this resistance in April 2012. It didn't go down to test that resistance again until it came down here, but it didn't even wait. It didn't flounder around that resistance, because it tried for 2 weeks to break this support rather on the way down, and the 3rd week it actually broke it down. It broke it down. So we've got one candle here, one candlestick here, where it touched this support, which was previously a resistance. It touched this support 1 week with this candlestick. Then it touched it a further week. The third week, it just went straight through down to this support. So again, if we're observing the news, we're listening to the news, we'll be able to identify with what the financial markets is saying to us on our charts. And eventually, we actually learn to think, what might they be trying to do? What might the buyers be trying to do? Where might the price be closing at the end of the day? Where might this price be closing at the end of this week? Where might this price be closing at the end of this month when you're a few days away from the close? If the price has opened, let's say the price opened at 1.300 and it's tried to go up to 1.400, and then it's tried to go down to 1.200, and then by Thursday it's hovering around 1.250. If the previous week's bias was bullish or so, I'd be saying, I mean, a day before the markets close or a few hours before the markets close, it's still hovering around the opening price for the week. I'd be saying that this is likely, it looks as if it's going to close as a doji this week. So after a while, we start to understand exactly where they're taking the price to, what they might be trying to do with that price. And trust me, the thing is that although it might sometimes seem as if, they're trying to catch us out, these market makers don't really care about our money as retail traders. They don't make money from us. They don't make that much money from us. They only make money from the big investors. From the big investors. They only make money from the big investors. Now, this is a chart which we can't really see that well, but I just wanted to show us again what's been happening between July 2019 and October 2020. And this is the daily chart. Now, if we take a look at this, we've got all these resistance points here. We can see that in November 2019, so I'm taking a look down here, November 2019, we were at 1.3236 on the chart. That was the price of GBP against the USD. Again, so that was a resistance. Now, please remind me, I'm going to talk about this gap. Okay, don't worry about reminding me, but I'll talk about it in the next few slides about this gap here. So this is the daily chart. Now, we've got resistance, 1.32360. That is resistance. That is a resistance on our charts. Then we've also got that same resistance here. This was in March 2020, where it hit this resistance and then the price action just fell. It just dropped through multiple supports. And this must have been around COVID, I think, because this is March 2020, the daily charts, daily candles. Then we went up to this resistance, which is around just a bit higher than where we were in September 2019. Then we came back down to same support areas as we were again in September 2019 on the daily. You can see all these candlesticks that align with over here. So there, and there, support. Then we went up to try and breach 1.2704. That's the price around here, which is a price that we were at in April, in March, before we fell down to this support. Same price again. Then we finally tested. So this is what date was this, or around what time was this? September 2020. We then again tested this resistance at 1.3540 that we hadn't tested since December 2019. If we look at that, sorry. So if we look there, December 2019, we actually went up here and hit a resistance. And then we fell from there. We eventually fell down to this support, which is 1.13680 in price. Then we climbed our way up, back up throughout the year until we tested that same resistance in September 2020 that we'd last tested in December 2019 and fallen all the way back there. So of course, if we fall if we do actually go up back up and test that resistance next week or so, due to the elections, we could break it. We could either break it and then go up to the next resistance, or break it and continue to trend in between 1.35 and the next resistance, which would be about 1.36 something or 1.37 something. We could continue to trend between there unless there's news that there's no Brexit or that there's no agreement with Brexit. Then again, what will we do? We'll simply start falling again all the way back down to this support. So that's all that the market does. It just trends between support resistance. And as long as we can identify where the next support is, where the next resistance is, we're all good. Just trade between those supports and resistances. And you've got all the time in the world to trade on your demo. You can trade on your demo, 30 days time, it will expire. All you do is you go in MetaTrader, you say open a new trade account, select demo account, and it will take you to your MetaTrader page on the broker's site, and then you log in and you download, and you don't need to download anything. You just register for a new demo account rather, and they give you a new account login and password, and you put that in and it's valid for another 30 days. So don't feel pressured to trade live rather before you're ready. Just keep practicing and watch out next week. So open your demo platform and watch out next week for election day. So see what your daily candle, see what the previous day's candle is actually looking at. I don't even know what day the election day is, but see what your previous day's candle is looking at. On Friday evening, see what the weekly candle is looking like as well. See what the weekly candle's looking like. See what the previous day to the elections candle is looking like, and see how things then play out. And if you're at your screen when they're announcing the election results and all of that, you may want to just turn on your laptop and switch to your 5-minute candlestick. Switch to your 5-minute candlestick. You can switch to your 15-minute, 4-hourly candlestick. Just switch in between those as the news is coming in, and see the shapes that those candlesticks form. So I'm not sure if you can see clearly here, but again, you can see this hanging man from when it reached the peak, and here's a very bearish candle as well, inverted hammer at the top when it hit this resistance. And again, a technical trader would have thought, okay, this is going down, it's time to sell. So now let's take a look. Before you can create a candlestick, before a candlestick can be created, there must be a set of data. That is the open, high, and low close values for each period. So opening price, the highest price, opening price here on a bearish candle, opening price at the bottom of the body, the highest price will be the top of the wick, lowest price will be the bottom of the wick, and the closing price on a bearish candle will be the bottom of the body. On a bullish candle, on the other hand, the opening price will be at the bottom of the body. The closing price will be at the top of the body, and then the highest price will be the highest of the wick. The lowest price will be the bottom of the wick. I think in about 5 minutes, we'll just take a 10-minute tea break. I've just been reminded. So here we've got a hanging man on this chart. Here's a hanging man, this little icon here. This is a weekly candlestick on the US dollar Japanese yen. Hanging man, we've got a hammer here. This is a hammer at the bottom of a slight fall, I'd say here. This was a slight fall, hammer, and then the price reversed and continued up. If that were the top of a if that were at the top of a rise, then we'd be pausing to see whether the price is about to fall. So these are different illustrations as to how these candlesticks can give us signals with regards to the price action. Now here's another candle, and forget the name again, but just look at what the price action is doing. This is a bearish Marubozu candle, and all that is saying is that the opening price is the same as the highest price of the period, and the closing price is the same as the lowest price of the period. That means that the price opened in a bearish Marubozu candle where the body is all white and there's no wick. That means that the price opened and it did not go up at all before it fell all day, and at the close of the period the price did not retrace to close a bit higher than its closing price. It simply opened at 1.300, for example, and then throughout the day or throughout the period, it went down as low as 1.200 and it closed at 1.200. So there was no wick at the top or the bottom. If that is a bullish Marubozu candle, all that is saying is that the price opened at 1.200. The lowest price of the day was 1.200, and then it went as high as 1.300 and it closed there at that price, in which case the candlestick would be black in the middle because it's bullish. So, and that shows you that the price action actually is very strong in the direction of the bearing. So if it's bearish, for example, if that's a bearish candle, then it's likely that the next day the price will be going down further because there's been no retracement of the price and there were no buyers. As soon as that period opened, 4-hourly, 1-hourly, whatever the period, as soon as that period opened, the candlestick, the price, the commodity rather, was met with sellers. And it encountered no support throughout the day, so it closed at the lowest price of the day. So what I'll do now is that we'll take a break and we'll resume at 8:40, or is it 7:40 rather? 7:40. Okay, so we'll resume talking about a few further candlestick patterns. So we've got the shooting star, and these are candlesticks formed when a price moves considerably higher after the opening, and then it retraces aggressively to close near or above the opening price. And it's also referred to as an inverted hammer if it's at the top of an uptrend. So we've got an inverted hammer example there. But I've also written mind the gap because it's important that we discuss this issue here about a gap. Sometimes what we get at the weekend in particular, but not just at the weekend, because I'll also refer to another instance here, but sometimes what we get at the weekend is where the market closed at a certain price on Friday night at 10 p.m. And then on Sunday evening, when the market opens in Australia, it opens at a price that is different to the closing price of Friday. That happens because there is sometimes news that's occurred over the weekend, fundamentals that have occurred over the weekend to cause the gap to arise. And this is why sometimes, or in particular, when we're just starting out, it may not be a good idea to leave trades open over the weekend. Because if there is a major fundamental shift or news, that could result in 100 pip gap, 100 pip difference between the price that the market closed on Friday and the price the market opens at on Sunday evening at 10 p.m. UK time. So again, if we've got a trade open, and let's say the price closed at 1.200, and I'll forget about all the other digits at the end, but it closed at 1.200 and it opens at 1.300 on Monday. Let's say that's 100 pips. It's fine if, let's say, you were buying and the price gaps up by 100 pips because you bank those pips. But if the market, if you were selling at 1.200 or even selling at 1.20 to 1.2020 or something, or let's say you've got a pending order in place, which is another reason why we expire. Make sure that all our pending orders expire, because if you've got a pending order or an open order at 1.2020 and you leave it open on Friday evening because it's in profit, let's say, if it's an actual order, a market execution order rather than a pending order, and it's in profit by 20 pips, and you decide to leave it open on Friday night with the expectation that it's going to continue down, or you leave your pending order open, you leave your pending order in place without an expiry date and time. On Sunday night, if the market opens at 1.300, then that trade will suddenly be in minus by 80 pips. So we need to ensure that our pending orders expire on Friday night. Don't forget to include an automatic expiration date, or you delete all your pending orders on Friday night. But let's give a big but here. It's not only on or over weekends that the market tends to gap. Let's say tonight now there's a sudden announcement that a Brexit deal has been reached. The market could suddenly drop or rise by 100 pips there and then. Again, if you're scalping or if you're selling at that point in time, again, one could be caught out. And if one's got a pending sell order in the path of that rise, again, it will pick up that order and one will suddenly be in negative. One's account will suddenly be in negative simply because one hasn't expired that pending order. So again, we don't just expire our pending orders, or we don't just configure our pending orders to expire at the weekend. We also configure, well, for now, or when the market is volatile, it's better to not include pending orders in place. When we've got all this Brexit or all these elections coming up, then we just make sure that we don't have pending orders in place. So we mind the gap. We watch out for those gaps. So here is our shooting star pattern at the top of an uptrend here. Here's a shooting star pattern here. Then here's a doji here. So all of these are just confirming that we're reaching the top of a long uptrend, because we were coming up from there, and we would have been coming up in previous days, on previous days there as well. This is the US dollar, Canadian dollar here, the loonie. And here we can see signs that the market is about to reverse. We've got this here, we've got that there. Then we had this big candle there, but it went back up, although it closed lower than its opening price. Then we came down to this support, which was previously a resistance when the price was on its way up. Then we came up to this support here. Then we went up to this resistance, came down to this support again. Then we went to try and test this resistance, but we didn't even reach there before we had this candle here, a gravestone doji there. Then we had this shooting star here, shooting star down there, and then down we went. So again, it's recognizing all these candlesticks. That's what the technical traders do. So again, these are different shapes as well that are, I mean, this is a bullish harami here. Sorry, this is the bullish harami. This is where the first candle closes lower than it opens, and then the second candle closes higher. That's that one here. This one, bearish, the first candle closes higher than it opened, but then this second candle, the whole bullish body, which is filled with white, is larger than this candlestick here, and it closes bearish. So again, just watch out for those. But let's now take a look at the fundamental trader, fundamental analysis. What is that? And we've talked about this. It's a study of a nation's overall economic health. And you don't need to go and start studying economics. You don't need an economics degree to understand all of this. But the idea is that the strength of a nation's economy will affect the supply and demand for its currency, which will in turn affect the price of the currency. So if the US economy is in a major upswing, the value of the dollar would be expected to rise, and currency traders will invest heavily in the dollar. So that would mean that you would get less dollars per pound or less dollars per euro if you're trading the euro USD. So fundamental analysts or traders, they just listen out to the news. They also listen out for major companies' earnings. So for example, if and it's what one thing that has struck me about all of this is that it's difficult to understand how traders place their trading decisions on the views of a few analysts. So for example, when we look at the economic news on Forex Factory, we'll see where, for example, if the US employment numbers, the number of people that have claimed unemployment this Thursday, so they release that news every week, unemployment figures in the US, and they also release their UK's. So they will survey about 30 financial analysts, and then they will guess the percentage of unemployment increase in the UK, for example, or US or other countries. And then if on Friday or Thursday rather, when the UK releases its employment figures, if it's higher than unemployment figures rather, if it's higher than the 30 analysts guesstimates, then they say that's good for the currency or bad for the currency. So how on earth a country or an economy can base its, base the value, or how come traders can place the value of a currency on the guesstimates of 30 or a handful of traders? That always strikes me as just being bizarre, to say the least. But that doesn't take away from the fact that fundamentals drive the market. Fundamentals drive the market. So let's take a look at sources for economic news. So that is Bloomberg, as we keep saying. We've got Reuters, we've got forexfactory.com, which we'll go to in a moment, and that shows us a calendar, but there are other sites as well. But we just use Forex Factory. There's forexfactory.com, shows us a calendar of economic news to be released and news itself. So whose speeches should we keep an eye on before we go there? So we need to keep an eye on the chairman of the Federal Reserve Bank of the USA, or the Fed, also known as the Fed. That is Jerome Powell. We need to keep an eye on the speeches of Andrew Bailey. Then we've got Christine Lagarde for the ECB, and then we've got the FOMC report. That is a report of the Monetary Committee, the Financial Monetary Committee in the US. We've got the ECB policy maker and reports. We need to keep an eye on that. When those are released, or when any of these people speak, the market moves. The Monetary Policy Committee, that is the Bank of England FCA Monetary Policy Committee that set the financial policy for the UK. When members of these institutions speak, that moves the market. We've got other data that moves the market: payroll numbers, unemployment benefit claims, interest rates. All of this data moves the Forex market. Now let's take a look at our other fundamental news before we again go to the Forex Factory site. Trade balance. That is the difference between a country's imports and exports, income and expenditure. Now, if a country has a significant trade balance deficit, then the currency will be weak, as everyone will be selling off the country's currency. GDP, quarterly release, summary report of services and goods produced by an economy. And everyone views that, traders rather view that as a primary indicator of the strength of economic activity in the country. If a high GDP figure is released, then everyone expects the country to raise interest rates, and that again is positive for the country's currency. We'll take a look at all of these. So again, key fundamental economic news that drives the prices of currencies and stocks: interest rate hikes or cuts, employment data, the most vital monthly news release that is usually released on the first Friday of the month at 1 p.m. UK time is the US non-farm payroll data. That is the number of non-farm workers that gained employment or that filed for unemployment. So US non-farm payroll released on Friday at 1 p.m. UK time. And it's best to stay out of the market then and just observe the price action, because sometimes within a second or a minute of that release, you can see the price going up by about 50, 70 pips. And again, if you're on the wrong side of that trade, then that won't be nice. Then we've got GDP data, we've got central bank governors speaking engagements, as I've said earlier, MPC, ECB, FOMC minutes, annual earnings statements of major companies. What sort of fundamental political news can drive the prices of currencies and stocks? Well, we've got the resignation of a prime minister, for example. We've got elections, we've got wars. All of these actually drive the stock market. Now I'm going to try and switch to Forex Factory and see if this system, can we see, please, my screen? And let me just go to the chat. Please, can we respond if we can see my screen, the Forex Factory? Yes, okay. So we're on Forex Factory. Can others see the screen? No? Kemi said no. So what can you see on my screen, please? Oh, okay. So let's just go here and share the screen again. Could we tell me when you can see it, please? Thank you. Okay, so what can we see on my screen, please? Okay, all right, thank you. So what I'll do is I'll pause my screen sharing. I'll actually stop sharing my screen, and then I will now share again. New share, and I'll go here. Okay. Are we okay now? Sorry, so what can we see now, please? Okay, yes. Oh, thank you so much. Thanks. Okay, I've just seen that. Okay, so we can see Forex Factory. So here's a forum. And as I said, I used to comment on this forum until I actually stopped trading, but I commented from November 2009 to April 2017. I think that was the last time that I was online. I think the last comment was in 2016. But more importantly, what we tend to get on this trade, we'll go through the different tabs there. So we've got the different forums, interactive trading, and we've got different peers and different things such as gold. I'm sure there should be gold there, daily gold analysis. We've got Locks Cable Corner. So that is someone that's relatively new. I haven't seen that in a while. But the oldest ones here are things like Euro USD, cable updates, that is the GBP USD, used to be in there all the time actually. GBP Japanese yen, oh, that is a really fast moving currency. I mean, it just moves so fast. And yes, whilst a lot of people used to make a lot of money, but if you're on the wrong side of a trade with that, so I used to steer clear from that. Then you've got the US dollar, Canadian dollar here. You've got Elliott wave analysis. Those are for those that follow the pattern of the chart. You've got US dollar, Swiss franc, that is relatively new. I think that's not the old Swissy one, because you've got that. You've got S&P 500 trading. Again, that's relatively new because there's only 727 posts in there. GBP AUD. But so basically here, a lot of traders tend to discuss trading. And there's a lot of noise there, because what you will find, oh, sorry, I should go to the last one here. What you will find is that somebody will say that they're, that I'm buying or I'm selling, and you see all these charts and people post their charts and people say, okay, we're hitting this support, I'm going to sell here, bearish zone. So you see all of these. These are people just giving their idea as to where the where the market looks as if it's going to go to. But people do get it wrong sometimes. That's the problem. So if you follow people's trades without actually understanding your own, what you want to do, and without actually understanding your support, your resistance and all of that, then again you could get into trouble being a follower, being a mere follower. And sometimes you'll see one person who's very experienced will say, yes, it's going up. And another person will say it's going down. And then you don't know what to do. And I remember years ago, so I've got a story to tell about these forums actually. So as I said, years ago, I used to comment quite a bit and to debate and discuss with people. And then in May 2015, I think it was around the time of the UK election, then we had, this was David Cameron then, who was contesting to be a prime minister. And I looked at all my charts and all my technical analysis, and I said to everyone, I think the market is going down, that I think we should sell cable and then also gold. No, not gold. I think it was oil. I think it was oil at the time, oil or gold, basically, and definitely cable. And so, and then there was this gentleman that was arguing with me and debating with me, and he used to argue with anybody, everybody. His name was Nene, I think, at the time. Used to debate, and he said, "Oh, that everyone in his office, he claimed that he was trading for Fidelity at the time, and he said that, oh, that everyone fell off their chair with laughter at my analysis." So guess what I did? I didn't trust my instinct, and I went and bought a lot rather than sell. And of course, because we had a hung parliament, each of the commodities and everything that I bought, currencies, fell by over 1,000 pips. And I lost so much money just because I didn't trust my instinct. And then loads of people were now writing to me privately on Forex Factory saying, thanks for the tip. Thanks for telling us to sell. And then one person actually said to me that quite a few people here actually are paid to tell you to go the wrong way. I don't know why. I don't know what that was about. I don't even know if it's true. But since then, I decided, you know what, that I wouldn't really listen to anybody other than to trust my own instincts. Trust your own instincts and trade your own plan. But there are forums here that you could just come and read up onto to just try and get a gauge for what people are saying. Then this is a new one, actually, I think, where people post their trades here. People post their trades on, what they've done or what they're doing. But one of the issues here again is, as you can see here, one person saying that they've bought at this at 1.1807. Another person said they're selling at 1.1806. So how do you know who's the right person if you don't actually understand yourself what the technicals are telling you? So again, there's plenty of traders here who will say that they're doing absolutely different things. So you need to know what you're doing yourself. And here it tells us the percentage of traders that are long and the percentage of traders that are short on each pair, on the majors anyway. 49% of traders are long on the GBP Japanese yen and 99 traders are short. That is 51%. So everyone will have their own bias. So again, learn your trade, trade your plan. Plan your trade, trade your plan. Now we've got news. So this is just news that is released about about the different currencies. For example, UK Prime Minister spokesman, much work to be done to bridge significant gaps remaining with the EU. What do you think that's going to cause? Of course, that means that we're going to have a sell-off of the pound. So the pound against the USD, the pound against the US, against the Australian dollar, against the Japanese yen, of course it will go down. So you had that 7 hours ago, and then at 1 hour 38 minutes ago, Reuters announced US new home sales drop, record low mortgage rates underpinning demand. Then of course, what happens? It goes back up again. It goes back up again. And now you've got this here again. Safe haven dollar up. So the dollar. So everyone's rushing to the dollar as a safe haven as coronavirus surges and US stimulus hope fades. The dollar gained on Monday as surging coronavirus cases in Europe and the United States. And it made traders turn to the safe haven currency. So what they're saying there is interesting actually, because when the US stock market is falling, then investors rush to the dollar instead as a safe haven. So that's why they're saying that as surging COVID cases are rising in Europe and the United States, well, everyone's rushing for the dollar as a currency instead of equities. But you can see how the market just goes up and down, up and down. And unless you understand your technicals, again, you could be caught out. Could be caught out easily. GBP New Zealand dollar lower highs point to an imminent breakdown. That's from dailypriceaction.com. So there are certain news writers that you could subscribe to. They don't sell signals. Well, I don't know if they sell signals, but they just give an analysis of the market. Dailypriceaction.com. I think they may be one. Then there's another one that I've got in my spam folder, but only because I don't trade. But again, there's different places that one could get daily analysis from. But again, don't trust your do not trust your do not trust anything that they're saying there, because they're simply trying to predict the trend as well. Whereas if you understand that trend yourself. Now, most importantly here, let's take a look at what's happening here. This is the most important page on Forex Factory itself. We've got the calendar, and on the calendar, this gives you critical news, economic news that will be released, or the times when people will speak. Sorry, could we kindly mute that single mic, please? Thank you. So this just gives us critical news on critical information as to, or times as to when news releases will come through and the impact it will have on specific currencies. Now let's take a look at last week's. I'll just go back to last week's because that will be filled with information already, and I'll look at. So China. So what this is saying is that at 2:59 a.m., 2:59 a.m. in in China, they released their GDP data quarter for the quarter in the year. That is in China. Now, remember what I was saying earlier, that they actually that traders base their analysis on a guesstimate of a few analysts, market analysts. So here now, before this red figure was put in there, let's just take a look at this. So China, that's the currency, Chinese yen, that it would have had an impact on. Impact would have been major. What is the data that was due to be released? The GDP quarterly, yearly figure percentage. Let's now click on this open detail box. This open detail box is simply telling us information, revealing information to us about the news release. What is the Chinese GDP quarter on yearly? And it says it measures the change in the inflation adjusted value of all goods and services produced by the economy. If the actual value, inflation value, is greater than that forecasted, then it's good for the currency, according to the financial markets. It's released quarterly about 18 days after the quarter ends. And here it says the data represents the quarterly value compared to the same quarter a year ago. And it says Chinese data can have a broad impact upon the currency markets due to China's influence on the global economy and investor sentiment, of course. And why do traders care about China's GDP quarterly information? And it says it's because it's the broadest measure of economic activity and the primary gauge of the economy's health, also called real GDP or gross domestic product. Okay, sorry, could we please mute that mic? Thank you. So that is the Chinese GDP quarterly release that was released last week, because we're looking at last week's. Now, what was the forecast? It was forecasted to be 5.5%. So some analysts that they've questioned or asked to provide an estimate have predicted a 5.5% increase in the Chinese GDP's quarterly output. So the forecast was 5.5%, and then the actual release, when they released that data, was 4.9%. And it's written in red because it was lower than estimated. So of course, that then had a negative impact upon the Chinese yen at that point in time. So maybe for the hour or for the 15 minutes or so, that would have moved the market. Or if for anyone trading the Chinese yen, which is an exotic instrument for the record. So it's very expensive to trade the Chinese yen, very expensive. So when I say the GBP Japanese yen, that's totally different ball game to the Chinese yen, which is an exotic instrument. So let's look at another major impact news here. Well, this was meant to have a medium impact. That is the ECB president, Lagarde. She spoke last week at 7:05 p.m. or something, because this clock is usually about 5 hours behind our time or something like that. So she spoke 7:05 p.m. on Sunday, October the 18th, and it was meant to have a medium impact on the euro. Because it was a Sunday, if that were major news, if she'd said something major, then the market would have gapped in either direction on Sunday evening when the market opened. And what was the news? So what was she speaking about? So if we click on details again, it says she was due to participate in a panel discussion at the virtual G30 International Banking Seminar. And if she were more hawkish than expected, then that's good for the currency. And it says that ECB President November 19 to November 27, that's Lagarde. And volatility is often experienced during their speeches as traders attempt to decipher interest rate clues. So this is as the head of the ECB. So we can read all of this information as well. We don't need to read it, but if you're interested in actually understanding what's moving the market, then you come and read the details of all of these fundamentals. But you need to know when Lagarde is speaking. You need to know when Andrew Bailey is speaking. You need to know when Jerome Powell is speaking, because all of these people here, Fed Chair Powell speaks. He spoke at about 6 p.m. UK time last week. That would have had a major impact upon the US dollar. And let's see what he actually went to speak about. Due to speak in participate in a panel discussion about cross-border payments and digital currencies at the International Monetary Fund's annual meeting via satellite. Audience questions expected. And of course, when people like Powell and Lagarde and Bailey speak, what happens is that the audience consists of journalists, financial journalists, who will ask questions. So when do you think you might raise interest rates? Do you think the US dollar will withstand this COVID-19? Do you think unemployment will hit 10% before we see a change? And all of these, the chair of the central banks, their responses will drive the pricing of the currencies or commodities in some instances, especially indices. So the US dollar index, when you have Powell speaking, of course, that will affect the US dollar. It will also affect the US dollar index. It will affect S&P 500, for example. Other news that will affect the S&P 500 is the monthly, or is it quarterly, earnings season, when all these big 500 companies in the S&P 500 start actually declaring their earnings for the quarter. They start declaring their earnings. That affects the value of the S&P 500. Now let's take a look at another. So monetary policy meeting minutes. When the different countries release their monetary policy meeting minutes, that affects the market. Have they suggested, the monetary policy committee members, have they suggested increasing the interest rates? If they have, then that suggests that the economy is on the mend. And that will then have a high impact on the market. But if they are bearish, then again, that will have a high impact, but that means that people will sell off the currency. And the currency is stated here: New Zealand dollar, AUD, Australian dollar, Swiss franc, euro, Chinese yen, as we stated, GBP, cable, euro, Canadian dollar. So all of these news, French flash services, PMI, that again, level of a diffusion index based on surveyed purchasing managers in the services industry. And then you have the forecast figure. You've got then the actual figure when the news is released. And if it's less than expected, worse than expected, that worse than predicted, worse than forecast, then of course it results in a sell-off of the currency stated here, which is the euro. And they say PMI, that is a leading indicator of economic health. Businesses react quickly to market conditions, and their purchasing managers hold perhaps the most current and relevant insight into the company's view of the economy. So again, we can come here and read up on what all of these sorts of news mean. German flash manufacturing PMI, again, that will impact on the euro when released, or when it was released last week. But let's go to this week's calendar, and we can see. So today's release, we've had some major news release. New home sales, sorry, a minor or medium news release. New home sales on the US dollar, affecting the new US dollar. The analysts predicted that they would have sold 1,025,000. They only sold 959K. And then that's had an amber impact. But again, it's had a medium impact, but in consideration that the market isn't doing that much because of Brexit, and particularly because everyone's waiting for the results of the elections, nothing that much happened today. So then we've got Australian dollar. So here, if you look at tomorrow's stats and Wednesdays, all we've got so far is the forecasted amount or forecasted data. But when the actuals is released, that's when we'll see it here. So one of the things that we need to do is to make sure that when we're doing our research over the weekend into or when we're planning our trades for the week, we need to make sure that we're not only looking at the technicals, but we're also looking out for what fundamentals is going to be released about the currency or commodity that we're going to trade. What fundamentals might be released? And we also need to be listening out as to what fundamentals is there about things like gold, for example, or oil. Is there a war breaking out in an oil producing economy, for example, over the weekend? In which case, we need to know that if we're trading that commodity, that that is going to be time to sell. And then if you look at your charts, you may find that the technicals also confirm that that price is trading at a major resistance or at a resistance. In which case, you know that, okay, that I'll sell this because I know that it can't rise too much before it starts going down. Now, here we've got the Bank of Canada's rate statement due to be released this week. Then we've got the Bank of Canada monetary policy report, Bank of Japan's outlook report. So that's the same as what the Bank of Canada is releasing this week, and the monetary policy statement. All of those will have a major impact on the Japanese yen. That will have a major impact on the Canadian dollar. Advanced GDP quarter on quarter, US, they'll release that on Thursday. Then we've got the Euro main financing rate, monetary policy statement, ECB press conference. When you have a press conference chaired by any governor of any of these central banks, then of course, then that means that the market will move. The market will move. So based on that, and don't worry about this being overwhelming to read and take in and understand. I just used to read it out of interest because some technical traders will say, as I keep saying, I don't read any of that. I don't bother with any of that. As long as I understand the candlesticks and I understand the charts, I see the chart patterns, I see the candlestick patterns, I'll just buy and sell within the trends. But I like to read this as I was asked during the break. I mean, as in what how do I trade? Am I fundamental or technical? I like to use the fundamentals to know when the market is going to actually turn in my direction. Now let's take a look at next week's charts. Let's just take a look at this because I just want to see. So as we can see, thanks Ems for telling us the day of the election. You can see here. So presidential election on the 3rd of November. So that's what we've got there. So that is stated as something that will move the market considerably. So, although another thing we need to consider is that if the if whoever the markets have stated will win actually ends up winning, or if the market were to have been predicted to go up or down by 1,000 pips, let's say the market has all predicted that Trump will win and he wins. They may have priced that in. Market makers may have priced that in. But if he were to then lose, that would move the markets quite a bit because that would be a surprise. So they may have priced in the winner already, and the market doesn't move like by 1,000 pips like previously. But because we've also got Brexit, the Brexit discussions, things could just go either way. So it's best again to just observe, 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 observe. You can't lose money by sitting on your hands and just watching. That's what I used to say, just sitting on your hands and watching. And if you can't sit on your hands and watch on your computer without being tempted to trade, simply close your laptop and watch the news on Bloomberg. Watch the market movement on Bloomberg. So we'll take another break here. We'll take another 10-minute break and then we'll return and we'll just, let's just take a look at this. So here we've just got charts, same as what we've got on MetaTrader. We've just got charts. You can switch to the hourly, 4-hourly. There's no weekly here though, daily and then monthly. So these are different charts. Let's just go daily here a second. I just wanted to point something up to us. So can we see this candlestick here? This inverted hammer, which showed us that this was going down. So again, if we just go and look at the bottom of each long fall or look at the top of each long rise, we can see across each of the charts that we're just seeing the same consistent candlestick patterns. So, okay. So some traders prefer to use indicators to trade. And there's absolutely nothing wrong in using an indicator at all, except I don't use them. I don't like my screen on my laptop being clogged up with icons, same as my charts as well, if I were to be trading. It's just very difficult to see the candlesticks for me personally when I've got indicators on there. Well, when I first started and someone showed me indicators and I just immediately switched them off because I just couldn't see anything at all behind them. But we've got two different sorts of indicators, and the majority of indicators are actually lagging indicators. And that's one of the reasons why I said from the onset that I don't want to use this, because they can't tell you what's going to happen until it's actually started happening. So a lagging indicator will tell you that the price is about to go down after it started going down. So rather than you getting in on day one of the move down, you may get in on day two. And because as newbies, we want to protect our equity as much as possible, we end up placing the trade on day two and setting our stop loss when the price may retrace for a bit before it falls. So the indicator is telling you that a trend has started, a reversal has started. But again, if it tells you it on day two of the move, So you haven't caught the reversal from right at the top of the move, of the reversal. You may be loath to actually place a trade at all. Or if you do place the trade, you go and place it, but you set your stop loss, and then you get stop loss during a brief, stopped out rather, during a brief retracement, and then the trend resumes in the direction, leaving you out of pocket and without a trade in place. So lagging indicators provide a signal to a trader after the trade has started, and that includes the moving average indicators and Bollinger Bands. And I often see a lot of those Bollinger Bands actually and the moving average indicators on Bloomberg. If you turn on your computer, you see traders working in the background and you see all these lines and everything across their charts, different colored lines. These are Bollinger Bands. So if you go to the insert menu of the platform, you can see these indicators. We saw those last week. But what do the moving average indicators do? They track the average price of a currency pair over a previous period, a specified period in time. So you can say that you want to set your moving average indicator to tell you what the average price of a currency pair was over the past 1 month, the average price. And then when if your system hits that, if the price today hits that average price, then it actually turns downwards. And it helps you to actually smooth out the day-to-day price fluctuations or noises. The volatility. The moving average indicators tend to just ignore that volatility and try to get you averages. Then you've got the exponential moving average indicator that includes more recent price action. So you could say, okay, up until yesterday, you could include that indicator on your chart to help you to determine when to enter and when to exit. But the problem being, as we said, that they provide a signal to you after the trend has started, rather than when it's starting, when it's actually starting. So Bollinger Bands, again, I just, you can see with your own eyes on your chart where the support and resistance are, basically. So you've got different deviations on your or on your Bollinger Band indicator that can show you, that can show you any deviations from the moving average. We can actually just place a few of those when we finish going through these indicators. We can place a few of those on our charts within our, within our MetaTrader. But again, they're just they just clutter up the screen. But some of you may want to use them. So here you've got your leading indicators as well, the ADX, the RSI, and the stochastic indicator. ADX, average directional index, and it shows the strength of a trend. So if a trend, if the it shows the certainty of a reversal. So if a trend is strong, if the reversal is strong, or if the ongoing trend is strong, if it's highly likely to continue in that direction, if the price is highly likely to continue to drop, then the ADX will have a high reading, and low readings indicate a weak trend. So the higher a price goes, that means that it's eventually going to hit a resistance. So the lower the reading will become, because the trend will continue to weaken. It will go up and up and up. A price will go up and up and up, and then it will eventually start to weaken, and the ADX reading will reduce. Will reduce. That's okay. I've got that message, KO. Thank you. So when we've got our RSI as well, that's a relative strength indicator, oscillator that measures the strength of a currency trend between the range of 0 and 100. So if a currency is overbought or oversold, then the indicators will show you. And if a currency is overbought, then that means that the market, sellers are about to step in. And if oversold, then that means that buyers are about to step in. But again, that's all based on historical price action, which we can see through our own, eyes, with our own eyes. Again, the stochastic indicator that measures overbought and oversold conditions. Oversold upwards trend may be forming. Remember the word may, may. And none of these are 100% perfect. So you won't get 100% positive trades or profitable trades using an indicator, just as you won't get the same using your own eyes. However, if you want to use an indicator, if you can practice using one or two indicators, there's absolutely nothing wrong in doing that. I just don't use them for any reason, but there's nothing to stop you from using them. We've talked about the support and resistance repeatedly. Support buying is thought to be strong enough to prevent the price from going down any further. So buyers will step in and they'll say, okay, I'm willing to buy this at this price. And resistance, where sellers step in and they then say, okay, I'm willing to sell at this price. And so that is your support and resistance. And that is one of the most vital concepts that we need to understand as traders. Just understanding the support, identifying the resistance, and then trusting our instincts in view of the news that we're hearing about the currency or the instrument that we're trading. Now, let's take a look at these areas that we can use to help us identify support and resistance levels on a chart. Previous highs and lows, previous openings and closes. Then we've got the trend line support, that is historical support. We've got an average of our opening high, lows and closes, pivot points. We've got psychological levels. We may remember that I mentioned psychological levels the other day where I talked about the zeros and 50s. If a price ends in 0, 1.3000 or 1.3050, those are good psychological levels where you'll meet buyers or sellers. Then we've got Fibonacci levels. Now there's a Fibonacci drawing or graph here on our charts. Again, I don't know why, but I tend to see those through the naked eye. But Fibonacci basically was a very historical mathematician who proposed that prices tend to retrace to 23.6%, 38%, 61 point something percent, and 78.6%. each time. So between a high, from a high to low, what Fibonacci said was that the price would retrace to 23.6%, 38.2%, 61.5 or so, and then 78.6% each time, which is fine, except you can draw that and fundamentals could just wipe all of that out, where the price retraces 100%. So that is another means of identifying support and resistance zones. But if you have your chart, you can visibly see, like the previous chart that I showed in the slides, where I had all those X's as resistance points and ticks as supports. So all of these just help us to identify support and resistance levels on a chart, previous highs and lows and openings and closes, trend line support, pivot points, psychological levels, Fibonacci levels. Psychological levels, so important. If a currency were to reach for example, Euro USD, $1 to €1 to $1, the ECB would intervene. Even if buyers didn't step in, the ECB would intervene and they would buy their currency back up. Then you've got those psychological levels. One thing we need to remember about them, though, is that even though we're saying $1 to €1, €1 to $1, it could go down to 99 cents or 99p. Let's use pound and cable now. Could go pound and US dollar could go down to 99p or 98p to $1 before the Bank of England intervenes. So when we say psychological levels, it could actually, the currency could dip below, just below that psychological level. But at least if you know that you've got a pending buy order at 99p or 98p or even £1 to $1, it won't retrace. The Bank of England wouldn't allow the pound to retrace to 80p or 88p, for example. So you know that you're safe in putting a pending buy order at £1 per $1. Because even if there's a retracement, it goes down to 99p, it goes down to 95p even, there will be some form of intervention. So those are psychological levels. Fibonacci levels, that's a percentage of retracement levels. So let's take a look at the Euro USD, the GBP USD. Now I'm going to just go to my screen again and see the what's it called? So let's just go to my screen and see if this actually is happy enough to. Sorry, can we all see this chart? Yeah, let's just see. Can we see? Okay, nope, we can't. All right, I will stop this share and I will resume sharing again. Yeah, I'm just going to do it this way this time because I don't know why Zoom is not happy with me. Okay, so can we see MetaTrader now? I've had to share the screen again. Okay, thank you. All right, so here we've got our MetaTrader again. And let's take a look at some of those indicators that we've just mentioned there. So there is our Fibonacci, but before we actually do that, I want to just reduce this so that we can see a few candlesticks. So we've got this candlestick here, which we can see is an inverted hammer, where this is a peak resistance, 1.34780. And we also had that previously. Let's just, I know what to do because this is going to take a long time otherwise. Let's just put a trend line in there so that I can see it as I scroll further away from there. Okay. Okay. So here we were again at this 1.3487. This was in December 2019 that we last reached that point before we attempted to reach there in before we attempted to reach there again in September 2020. Now let's actually go to there when we reached there last, because I want to actually just open up the Fibonacci indicator, and then to see where we got to there. Oops, Nathan. Sorry, let's just delete that. And I may want to just delete all these pending orders as well, so that we've just got a normal chart here. So this is the pending order that I left there the other day, so I'll just delete it. I actually thought that I put in an expiry thing, but I didn't. Oh, the market is closed. Okay. Whether for some reason the market is closed, but I won't even start to investigate that now. But let's just try and put in a Fibonacci, close this terminal off. And then I'll put in one of these. Yep, and here it is. So what this is saying is that the market tends to retrace, as we said, by 100. That's 100%. Then we have 23.6% here. This is what this is saying, according to Fibonacci, that we should have a resistance here. Then another resistance here. So this from high to low. Another resistance around here. Another resistance around here, 50%. Then another resistance around here, 61.5 or so, and then 100%. So that's what the Fibonacci enthusiasts will have us trade to, where we know that when it reaches here, that if we're going to place a buy order at this low place, that the first place that we should be expecting to take profit is here, around here, 23.6%. And then we should be taking profit next at 38.2%, and then at 50%, then at 61, it's 61.8 here, and then 100%. So that's one indicator that we could use for our trading. And I'll delete that. So I've just right-clicked on that and gone into objects list. Then there's also these other indicators that we were talking about earlier. Indicators. So we go indicators, and then we have our average directional movement index. and that gives it to us here. So again, if this is over 20 or something like that, they will have us think, or over 70, then the strength is strong. And if it turns up and it's over 70, then that means that the uptrend, the direction of the uptrend is strong. But for me, as I said earlier, sometimes this will turn only after the tide has changed. So here we've got this candlestick. Let me just increase this. Here we've got this candlestick suggesting that the market was about to fall, that the price was about to fall. And yet, if we go right down to that day, or around that day, the price didn't actually turn to go down for a day or two, or the indicator didn't turn downwards for a day or two. So you could feel tempted to continue to buy based on having this indicator open, because it's a lagging indicator. But again, you could learn to use this indicator or learn to use it properly and just use it to trade. But for me, I prefer to just have the screen just clearly open there. So let's take a look here. It started to turn downwards now here at the end here. But the question is, if we have Brexit, good news about Brexit tomorrow, will this turn upwards before then or not? And I doubt that will be the case. I don't think that if we have an election outcome tomorrow, that this will suddenly turn up. It will turn up the day afterwards, or it won't turn up before the election results anyway. So let's close this. Let's take a look at another indicator. We had others there. Let's see, because there are some here. There's loads. There's moving average. There's stochastic oscillator. There's trend. Here's the Bollinger Bands. There's the moving average. Let's just go there. And here you have different Bollinger Bands. And they're basically here. I mean, so you trade between the support and the resistance, support and resistance. But if you take a look at here, it was still continuing up. This band was still continuing up, even though the market turned down from here. So again, it's up to us as to whether we want to really learn an indicator or learn to really trade well. And again, if we buy indicator signals from individuals, or from, in quotes, professionals, all they're doing is they're learning these indicators and then providing signals based on this. They're providing signals based on that. And if they give us signals that, okay, that the market is about to turn today, and it doesn't turn today, and we sell, there's no comeback. They don't pay us back anything to say, sorry, we were wrong. So based on that, let's learn this. And we don't have to learn the indicators. We don't even have to learn the fundamentals. We can actually just trade based on learning the candlesticks, learning the shapes of the charts, understanding where the supports are, understanding when we reach a double top, or understanding not necessarily when we reach a double top, but knowing where we're headed to. So if I change this to a weekly chart, for example, I know that next major resistance on this chart is on the weekly is here at this point. That is a major resistance. We had this candlestick here. in the week, I'm trying to get this week of 8th of December 2019. We also hit the same resistance the week of the 30th of August 2020. Now, if we're going to that resistance next week, due to the election outcome, we're either going to break it or stay up there, or we hit it and then we come down again. If we go up, if we continue up and we actually break it, then the next main resistance is somewhere up here, 1.36, which I mentioned earlier. It's somewhere up here, 1.36, where this candle peaked. Let's actually see the price of that candle. I'm trying to just get onto the opening price. Yeah. So it peaked at it opened at 1.35570, and this was 2017 actually. 1.35570 was the opening price. Highest it went to was 1.3656, and then after that, for the next few days, it fell to 1.30264. That was the lowest before it then tried again, and it just floundered around that resistance of 1.36 for a while before it eventually broke that resistance. So that was across about 5 weeks on the candlesticks, broke that resistance, went up. So next resistance from 1.36 was the opening price around here of 1.3800. And when it broke that 1.3800, it then went up to 1.43600 around March 2018. So those are all resistance levels that we need to look out for over the next few weeks. If there's a big run up, maybe because we have a Brexit deal, yeah, then we could actually get up there, get as far as there. Or we could get to 1.38, 1.36, 1.3600, and then 1.3800, and then come down again. And the indications, not indicators, the indications will be in the candlesticks and in the charts. But if we don't manage to break this resistance up here, then we could have, let's say they say, okay, no deal on Brexit, then we're coming back down there for 1 week and then back down here again to test this support again. So that's all the market does, as I keep repeating. Now let's take a look at placing a new order again. So remember that we said that we choose our symbol, which could be anything here. We could go for the Australian dollar USD, or US dollar Canadian dollar, JEPI, Great British Pound, and versus Japanese yen. We could go for the FTSE 100 index, S&P 500 index. Then we go for the Bitcoin versus US dollar, Ethereum versus US dollar, Litecoin USD, Ripple versus US dollar, Brent oil, crude oil. Then we've got the different shares, Facebook, Amazon, but we're trading on the spot market. So we're not actually owning Amazon shares or Google shares. All we're doing is we're trading these shares on the spot market in exchange for our currency that we, or equity that we have invested in this trading demo platform in this instance. So let's take a look here now at GBP USD. And we're not saying market execution now, we're actually saying pending order. We're going to say pending order. Oh, and the reason why the market indicated that it was closed earlier is because, let's take a look at this. Let's just go back, because I must have been on a commodity where the market is closed, because some of these commodities do actually close. Stocks and shares tend to close at a certain time of the day. So let's see if I can sell this. Let's just do let's just go and try and see if I can. So commodities, shares, some of them will close at a certain time of the day. So let's go for Apple and see. Yeah, so the market is closed there. Let's just go and see whether I can. So it says I can't even sell it now. No, actually, yeah. Oh, it says 15-minute delay on the execution of that. Wow, which is quite interesting because I haven't seen that specific delay before. It's either that the market is closed totally, or or the market is open. But that says 15-minute delay. But let's take a look here now at buying or placing a pending order for the GBP USD based on what I just said earlier. So if I think that, okay, that the market is going to hit a peak at 1.369, I wouldn't really want to place my order at 1.4369. I'd go and place it at a high of here, for example, because it may not actually reach that resistance before it starts falling. So I'll go for 1.4240, which was the opening price of this candle. So I'll go place a pending order. So let's just go new order, new order, and I'll go to pending order. Because the order is so far out, it's a major support as far as I'm concerned. I could say, okay, that I'm willing to place 50 cents per point move, and I'll put a stop loss in of about 100 pips. So let's just place the order first of all, and then I'll calculate the 100 pips afterwards. 1.4243, and then I'll place a stop loss at 1.4 3 4 no 430. The only reason I'm doing that is because I've got $1,000 in this demo account. Please, let's remember it's a demo account. So I'll do that. Sorry, I've got that 1.4 2 3 4 30. No, I'm actually sure that I've got that wrong, but I'll fix that in a moment. Yeah, 340. 1.4340. So that is 100 pip stop loss, because this account is a $1,000 demo account. So that is 50 cents per pip move, and that is a $50 hit, that loss that I'm actually staking, because my anticipation is that when it gets to 1.4243, it may rise by another 50 pips or so based on historical price action. But then I'm anticipating that from there, that we're going to actually fall back down, that we're going to fall to at least at least by 1,000 pips. 1.3, I could actually say 1.3023 for where we are now. But I'll put an expiry date in it, which will be the end or the end of next week, let's say. So let's say 05 0511. Okay, saying invalid stop loss. So I have missed something there. 1.5243, 1.5340. Oh, because I didn't change this to sell limit. Yeah, and that's sell limit. So if we take a look here, what I've done here is my pending sell order, 1.34 something. Then my stop loss is above here on this red line across. And then my take profit is down here at 1.3 thousand. So based on that, that's how we calculate our pending orders, or indeed our normal orders. We take a look at historical price action. We take a look at major supports and major resistances of previous candles, and then we place our pending orders. We take a look at previous supports or previous resistances to take profits, and we also calculate a stop loss for each trade. For each trade. Just looking at the chat window here. Questions? Questions. So that is gold, as I said there. Sorry, that is GBP USD. Let's take a look at gold. Let's take a look at oh, thank you, Emran. Let's take a look at another commodity. But I'm hoping that we're seeing that each chart is the same, except the exotics. And I'm not taking us to the exotics because the Chinese yen, all of those exotics are just so, I mean, they're just expensive. They're expensive. But let's look at gold, for example, because I'd like us to look at gold, spot metals. That will be here. There's also silver. There's also other commodities on there. But again, can we see candlesticks are the same? Doji at the bottom here, bottom corner here. Let's go weekly. You see your hammers there. Your hammers, you see a doji there. Let's just increase this. See a doji there, price went down, then it went up, there. You see this one here, which is a candle where the price opened, didn't go high, and then it closed almost around its opening price. But support resistance, same concept here with gold, with any commodity. Can you see at the top of here? And it's formed, you've got this this doji here, then it came down here, then it went up there. Resistance, try to reach that resistance again, try to reach that resistance here. So this was around 2016. Reach that resistance up there, came down to this support, then it went up there, then it went up there. Try to reach that resistance again in July 2017, which was a year after, just over a year after it reached there. Then it again tried to reach that resistance in January 2018. And then it fell down to here, tried to go to this support of October 2016, didn't quite get there. And then it now went up, hit that resistance again from December 2017, hit that resistance again in February 2019, came down to this same level of support. This is gold now, and then it finally breached that resistance, long-term resistance, and it continued up until it reached this top here. Now with gold, what is going to happen soon? So it's reached this resistance, probably reach it again, may spike a bit higher, may spike lower. Let's actually see on the monthly when it last reached that resistance. Okay, if we look at the monthly, look at what happened 2 months ago with gold. So it hasn't reached this level in years. 2011, we were at gold 190 to $1, but look at it now. So we're just above there, and 2 months ago was when we first breached it. And look at the doji here, solid doji. That suggested that the price was going to fall the next month. And if the price does not breach this, if the price does not breach this this price by the end of the month, then we could again come down to this support at 1743.65, or we could be in for a bigger fall down to 141 or down to 1481. 1613 would be the next support, and then 1481, where you'd see it, giving us a few monthly candles like this, but on the right hand side. So each chart is usually the same. Each chart is usually the same candlesticks that you see at the top, same candlesticks that you see at the bottom. So you can trade any commodity, any instrument you want to, once you've mastered your understanding of these candlesticks. So don't fear, don't worry that, oh, well, that I don't understand a thing that we're talking about here, because the fact is that you learn every single day as a trader, every single day, every single day. But this, from what I can see here now, if I were trading live, I would just place a pending sell order up here, just in the middle of this wick, just in case we don't actually go to the top of that. So just in case we don't breach the top of that wick again, to set another high. But even if I were placing a sell order from here, I'd just use 150 pips stop loss, knowing that once it breaches that and goes up to 2090 or something, it's not going to get beyond there. It's going to be a miracle if it gets beyond there, because that has reached a peak. That has reached a peak, a historical peak, and so we're soon going to come down with gold. We're soon going to come down from that historical peak. So based on that, that's what I would, that if I were trading live, I'd just go and look for, if I had £1,000 in my account, if this were a real account, £1,000, I'd just place a sell order there and then just leave it. Because even if it were to go up by 200 pips, I know that the potential to fall back down to 1522, which has been a long-term support, to fall down by about 500 pips is really great. So I'd be willing to risk 150 pips for that 500 pips, that if it goes beyond where I anticipate it's going, then it should stop me out. But I doubt as to whether we're going to go up beyond 2,190, let's say, on this. This looks as if we've reached a peak on gold, especially with this doji sitting in the middle right there. There, that one, that bearish doji. So what happened in that instance is that the price opened at this lower left to right, this bottom bar here on this filled bar, opened there, went down and up. Not sure which direction it went first. I couldn't see that, or couldn't tell that without looking at the weekly or the monthly or weekly or daily candles. But during that month of August, the price went up to 2069, came down as low as 1862, opened at 1978, went up to 2074, which is 100 pips up, went down to 1862, which was 110 or so pips down, then it came and closed lower than its opening price, which is why it's got this white fill in it. If it closed at the exact opening price of the month, then it wouldn't have a white fill in it. It would be a perfect cross. And if it closed higher than the opening price, then that would have a black fill in the middle. That would have a black fill in the middle instead of a white fill. So based on that, as long as we learn our candlesticks, we get a feel for our support and our resistance, we do quite well in this. Because it really isn't that difficult. It sometimes we make it more complex than it actually is, because we think, oh, it requires a good knowledge of maths, or it requires a good knowledge of this or that. It's nothing to do with maths, actually. The only maths that's involved, which many people don't actually do, is to calculate each trade. Just calculate each trade so that you're understanding, okay, how much equity do I have at play here? If I place a trade for 10 cents a pip move, how much would I potentially lose if this were to go 200 pips against me? And that would be $20 at 10 cents per pip move. But if that same trade were to go 500 pips in my direction after going 100 pips against me, because until you actually close the trade or until you get stopped out, even if that trade is at minus $10, you still don't get locked out. That money doesn't get taken out of your account until the trade is either stopped out because of your stop loss, or you physically close the trade. So a trade that is in minus $10 deficit could still reverse and give you your $50 profit. Yes, you're right there, Sonny, about the candlesticks being the most important part, but as long as we're also recognizing the importance of the support and the resistance. So candlestick patterns tell a lot, but the support and resistance, as long as we know that those are the boundaries that will help us know where to take profit, that will help to give us a better entry price than someone who doesn't have that understanding of the support and resistance. It helps to give us a far better entry price than us entering blind with no knowledge, and having a knowledge of the fundamentals as well will give us an even better knowledge, because that will help us to identify when things might change, when the price might make a move, when the price might reverse. So we know that there's a support, we know there's a resistance, and the price is approaching the support or the resistance. So I'd be thinking, okay, we've got the elections coming up next week. If this market is going to actually break that support or resistance, that will be the time. Or according to the calendar on economic news releases, this Friday, Barnier, the Barnier from Europe, and Boris Johnson are holding a private meeting to conclude Brexit talks. So I'd know that, okay, on Friday, that's when the resistance is either going to be broken, or we're going to go up, or we're going to go down. So having an understanding of both the support, the resistance, then the fundamentals, then the technicals, the candlestick shapes, the chart patterns, the double tops, the head and shoulders, all of those patterns, having a full understanding of that will help us to become better traders and help us to make winning trades most of the times. Most of the times. And if you're patient, if you're someone who only goes in when a pair or commodity reaches a peak, if you just go looking for all the charts, okay, this is reaching a peak, it's reaching a top, it's reached the highest value that it's ever reached. If you go in, if you go looking for any chart across all the charts in your demo, and you just place one trade a month on, say, gold that has reached a peak, or on GBP USD, if that were to have reached the peak, or anything on oil. Let's see what oil is doing. Let's say we just reach, we go for that. So let's look at oil. We'll go for crude oil. So you see that that has reached the peak, and that is the one trade that you take a month, or that has reached the or support, the lowest that it's reached in years. But the crude oil hasn't reached that. It hasn't got to that point. But let's say that it were down here, historical low. What you'd be doing is and this, it reached here in let's see, April this year. So if you'd known that that had reached the historical low, and you were to buy that and just hold, close your laptop and walk away. Close your laptop and walk away. They're telling you, and what sometimes happens is that it reaches that historical low, and the news, everyone's still saying, oh, it's bearish, it's going to go down to $6 per barrel, when the lowest went down to, it was $9.86 per barrel, $9.86 per barrel, here in this candlestick here. Well, if you recognize the signs from the candlesticks, you switch to the daily, you switch to the weekly and all of that, you could buy at $9 per barrel and just hold, knowing that even if it goes down to that $6 per barrel that the market makers are saying, or the speculators are saying, you could hold that, knowing that the next resistance is up here somewhere. The next resistance would have been something like 40 closing price. Let's see what the closing price on this was. Let's see a second. Yeah, okay, so the next resistance would have been around $20 or $22. So you could buy at that $9 per barrel, or even $10 per barrel, let's just say. You buy there and then you hold, knowing that even if it goes down to the speculated $6 per barrel, that it's still going up, that it will reverse from there. So if you go scouring all the charts, you see that a commodity or an instrument or a currency, that it's hit the lowest that it's ever been at, or it's hit the highest, or that it's going to, or it's approaching a double bottom or a double top, then just buy and hold. And in that case, I can say that traders like that, who are trend traders, who just trade the peaks and the lows of, they would rarely lose, because you're not over trading. You're just making one trade a month. Making one trade a month, making sure that that trade counts, and you could earn a living by doing that. You could earn a living by simply just, picking up whichever of the commodities or currencies that you see have reached a historical low. Place your trade, calculate your trade first of all, so that you know how much you've got in your account. Calculate that trade. You know how much how much drawdown you can bear. Once you've done those calculations, place the trade, close your laptop, walk away. Because eventually in that month, that trend will reverse. It will change. It will change. And when it changes, you open your laptop at the end of the month, you find out how much you've made, close the trade if it hasn't closed off, and then you open another trade for the next month. That is one strategy of trading that will ensure that you never lose. So let me stop sharing this and try and go back to the slides. But let me just see if there are any questions on this. No, there don't seem to be any questions. So I'll just go back to the slides now and see if this actually takes us back to the slides. Okay, and then let's go share screen, and then we'll share this again. Okay, let's go to chat window. Yes, you can see it. You can see what's that, Ems? The slides? Yeah, thank you. Yep, that's it. Thanks so much. Okay. Yes, so hopefully everyone's just following us along here and just reassuring you all again that the most important thing about trading is understanding that it's not so difficult. We are yet to get to the most difficult bit of this course, which isn't as difficult as we think it is, but it is still difficult. Yeah. So pivot points, strong levels of support and resistance. So, and that's calculated using an average of the high, low, and close from the previous time frame, previous candlestick. If a price is trading above the pivot point, then it's considered bullish. Whereas if it's sustained trading below the pivot point, then it's considered as bearish. So that's a calculation of the daily high, low, and close, or the previous 4 hours candles high, low, close. And what happens is that when a candlestick closes, the previous day's pivot points of the open, high, low, close become, or the previous candlesticks open, high, low, close become a support and a resistance. So pivot points, Fibonacci, then you've got the psychological levels, as we said earlier. So these are all levels that one can trade at. So what is a multifaceted trader? So this is in response to a question earlier that which method do I prefer, technical or fundamental? Really, I just prefer using a combo and using the fundamentals to determine when a trend is going to end or resume. Now let's take a look at technical analysis. So on the 23rd of June 2016, and we've seen that candlestick, cable reached 1.50, just above, a slight bit above that psychological level of 1.500. So they moved the price up there. It was creeping up that week. And this was a major resistance. It was the highest price of cable that year. And also, it was a psychological level. Then what happened? The fundamentals that drove the market to drop by 1794 pips on the 24th of June was the negative outcome of the referendum. So somebody using both a technical and a fundamental analysis would have known that on the 24th that we would drop. So on the 24th, we dropped by 1,794 pips. High to low, the total pip count was 1,894 pips. Now in January 2009, I wasn't quite trading then, started later that year, but cable dropped by 1,801 pips due to negative news from 1,000, 1.5373 to 1.3501. So I did those calculations and it was 1,801 pips. So that was just 93 pips lower than what happened 7 years later, 7.5 years later. So again, trends, trends. The trend is your friend. So a multifaceted trader will take a look at both of those instances and recognize that, okay, that, that regardless of anything else that's going on, the most important news of 2016 is going to be the referendum outcome. So I'm going to take a look at all the candlesticks leading up to the week before the referendum, the day before the referendum, an hour before the referendum outcome, and I'm going to place my trade based on what I see. That's what using a combination of methods actually means. We take a look at the technicals, we take a look at the candlestick shapes and everything like that, psychological level we're approaching, all of that, fine. That is technical analysis. But then we also need to think what might cause this currency pair to fall. I can see from the charts, from the technical analysis that this is going to fall. But what might drive it to fall? And it's the news. So that's using both your fundamental analysis and your technical analysis to actually place profitable trades. So trend trader, again, using price action to identify trends using a naked chart, basically. And if we can just watch our charts without any indicators, listen to the news, but just watch the charts. Change your 5-minute candle, change your 15-minute candle. See what those are saying. Change your 4-hourly candlestick, see what that's saying. You can actually even open 4 screens at once on your charts, 4 charts at once. So if you maximize and not maximize, you minimize all of them or you arrange them. So you can open the same pair and then just arrange them in 4 little screens on your computer in MetaTrader. So you can watch one being the 15-minute, hourly, 4-hourly, and daily candlestick, just to review the price action. And if all 4 candlesticks are suggesting that you need to sell, then you may as well sell. And you've got to a resistance. Then you just sell all the way down. Trust your instincts. So we've taken a pending order. We've placed a pending order. Now, let's take a look at. We'll just take this last slide, please, because and then we'll just call it quits for today. Now, trader psychology. This is so important. This is the most difficult bit of our trading. Remember, I said earlier that we haven't yet gotten to the difficult bits. Trading is not an issue for most people, but it's our psychological makeup that actually affects our trading, whether we're going to be successful or not. Right. So what are the different traits that can impact upon our trading? Overconfidence. We've made one successful trade and we think that's it. Yep, I've perfected everything. Greed, where we cannot simply turn off our laptops and walk away. And that's why I don't like installing MetaTrader on phones, or suggesting that people install it on mobile phones. Because when you've got it on your mobile phone, then you watch it all the time. You have it open all the time. On the train, you're there watching it all the time. On the buses, wherever you go, in a meeting, you're there watching your MetaTrader because you don't want to lose a penny. Or you take trades that you haven't planned for simply because you've got MetaTrader on your phone to hand. Revenge. What is revenge trading? So you've just taken a trade, lost a whole pot of money because we didn't calculate the trade properly, and then we instantly go back to try to get that money back without planning, without doing any analysis, and we lose again. Fear, which is one of my weakest points in terms of trading. I've lost more in terms of opportunities than I've lost in equity. I remember one year when gold was approaching that year that it actually approached 1.91 something. It may have been September 2015 or something, or whatever year it was, but I remember it was approaching 1.91 something. And all the analysts were saying it's going to go to 2008 or something, $2.008 per gram of gold, or whatever the measurements are. So I decided to put an alert on for when it hit 2008, 2.008 or whatever the figure was. And I woke up one morning and it had hit 2005 or something because of the spread, and it had just reversed without me having placed an order, simply because I'd set an alert rather than put a pending order there, rather than put a pending order below that resistance, just below that resistance. So fear can cost us just as much as greed can in terms of loss opportunities. Procrastination, where we're thinking, oh, yeah, I think it's going to get there, but I'll just wait until it gets to the exact pip count. I think it might get there, where we're not trusting our instinct. And then, of course, impatience and over eagerness, where we're not planning our trades, we're simply impatient to make profit. And that's why I recommend that we start with $100 and just try and build that up slowly. Build it up slowly, slowly but surely. Keep building up our equity. Build it up slowly, because the market is not running away. It hasn't just started. When I first started trading, I thought, oh my goodness, wow, you can actually make money in this market. But fear stopped me. And then I learned to recognize that, you know what? This market has existed long before I was born, and it will exist long after I've passed on. So why be fearful? Why be impatient? Why be over eager? So again, I'll repeat, it can be one of the easiest skills that you'll ever learn, the easiest thing that you'll ever learn. However daunting it might seem now, it might be the easiest thing that you'll ever learn when you've reviewed things, you've visited other websites that will tell you about, and we have no shares in Forex Factory, we have no shares in babypips.com. All of these sites that we'll refer you to are free sites, free of charge, totally free of charge, where you can learn more, you can hone your skills. So it can be the easiest skill that you'll ever learn, but again, it can be the hardest in terms of trying to actually change your way of thinking and to control your personal, psychological traits. of either greed, fear, procrastination, or impatience or overconfidence. So let's see, we'll go for this last slide. Yeah, most of the mistakes that traders make, over trading, where we're there day in, day out, placing trades on our mobile phone or on our laptop. Oh, I'll just quickly place this one and I'll quickly place this one again. Gambling, it can become an addiction if we're not careful. So, over trading, gambling, trading live before we actually understand the market. There's no pressure on anybody to go live. If you feel that you're under pressure to go live, maybe because of financial need, that's the wrong time to go live, because you're more likely to lose money when you're just trading out of anxiety. So don't go live before you understand the market. Not promptly taking profits as well, or promptly withdrawing profits once you've made enough profits. That's another mistake that we make. Sometimes we build up our accounts to such an extent that we think, oh, I can now start trading $2 per point move. So we need to promptly withdraw our profits, and we need to promptly take profits until we're sure, until we're better at trading, opening trades for the long term. We promptly withdraw our profits, being mindful of the fact, though, that for each trade we open, we're just paying the broker for that trade, when we may sometimes need to just let a profitable trade run its course. So rather than taking profit at 10 cents per pip move, when it's gone down to 50 pips, if it looks as if it's going down further and it might get to a resistance 200 pips away, move your profit to stop loss. Move your trade stop loss to break even, and then let the profits run, rather than close that trade and then open another one which may retrace, stop you out, and then continue in the direction that you thought it was going. So most of the mistakes we make, also moving our stop loss. I mentioned this at the beginning of this workshop. We don't want to move our stop loss. Once you've calculated that trade, leave the stop loss. If it stops you out, then you'll calculate, you'll get better at calculating your stop loss. Self-deception, praying that the market goes in your direction when you've taken an unplanned trade. My husband and I used to joke and laugh when things weren't going too well for us in our trading, that there's no God of Forex. So don't start praying after you've placed the wrong trade. There is absolutely no God of Forex. So plan your trades and trade your plan. And don't add to losing trades. If you're losing, let that trade actually, run its course, where it either stops you out and then you have equity to start again. But don't keep adding to a losing trade with the hope that it might go in your direction. That is what Kweku Eboli did. Remember that Ghanaian trader a few years ago that unfortunately lost his job due to him over trading, and he actually went to prison as well for it. So don't add to losing trades. If a trade is in a negative, or it's losing, it's costing you equity, don't add to that trade. Don't open a new trade. Let that single trade run its course, where it either stops you out or it reverses and goes in your direction. Over leveraging, opening too many trades, not calculating each trade. That's another mistake. Too tight stop losses. That's before we actually learn. And the more you place stop losses, the better you get at them. And if you're calculating each trade, then of course you'll get better as well. Because if you're calculating that if I place this trade at 10 cents per pip move, then I can afford then I can actually afford a 50 pip stop loss on a $100 account, because that will take out $5. But if I place that same trade at $1 per pip move on a $100 account, a 50 pip drawdown will cost me $50. So we don't over leverage. We calculate each trade. We don't place too tight stop losses. And we need to have a trading plan, which we'll talk about on Wednesday.